Hello, everybody, and welcome to Confident Compounding with Corey Kramer. I debated a lot today over what video to make. We had so many earnings that came out this week. I did make a couple videos on some of those earnings and reactions. More recently, we got Meta, Apple, Amazon, and Microsoft. Meta and Microsoft looked pretty good, and Amazon sold off on the earnings, and Apple I think maybe was I think they had revenues up more than expected, but the stock was relatively flat. And then I think everything's down today. I'm recording this on Friday before the market has closed, August 1st. And so we also had the Fed hold interest rates steady, but we had two dissenters who thought that we should lower interest rates in the U.S. We had the jobs report, which is which I have pulled up here on CNBC, that came out this morning, which was much lower than expected. I'll talk about that in a second. And we had a whole new round of tariffs go into effect today. And so it kind of happened to me yesterday and then I had a lot of stocks I own that were reporting that I was looking at, and some of them were pretty good, and then other ones were not so good, and it was just all over the place based on news and earnings and everything happening at once. And I really struggled to think of what I could make a video on that was like actually relevant and not super narrow. I usually kind of just go back to my list on days like today and just pick something, because there's so much to talk about that actually does affect the market and the economy. And so I just thought I'd make a macro video and just talk about the things that are out there without narrowing in on specific stocks, which is what I prefer to do. It's been a while since I've done a macro video, and I think it's worth kind of zooming out a little bit to get as much as we can, a bigger picture of what's going on. So I think the one thing that has happened that I predicted would happen at the beginning of the year is that Powell is going to be the scapegoat for the struggling U.S. economy. And the economic picture, GDP also came out, and it was higher, I think, than expected. But I think the last GDP report was lower. The thing is, like, the tariff pull forward and then kind of adjustments and delays and everything, you combine those two together over the past 6 months, and you had one report that I think was a little too far one direction, and then this one was a little too far probably the other direction. So those are, you can't look too much into either one of them, I think. And you just kind of have to wait for more information, which is kind of what the Fed was saying on the whole, or Powell was saying. So, but we're seeing what I expected, which was that Powell is going to be the scapegoat. He will be replaced eventually, if it's not anytime soon. I'm not sure they're in a big hurry to replace him, because as the economy slows, and jobs especially, and pay especially relative to inflation, they need somebody to blame. And the plan all along was to blame Powell. They even had this stupid meeting at the Federal Reserve where Trump tried to say that they went, I don't know how many billions over budget, and they added in like a building that had already been built for 5 years. I don't know if anybody saw that. I mean, it was complete stupidity. But the plan is pretty obvious. I mean, it was obvious to me at the beginning of the year what was going to happen, and that's what's happening. So we will have lower interest rates in the U.S. The president wants lower interest rates, and he's going to keep doing what he needs to do in order to get the short-term interest rates down, which is what the Fed controls. So at this time next year, interest rates will be lower, whether we have inflation or not. And if we do have inflation, they'll make sure that people that are collecting the data can get the data to say what they need them to say. That's kind of my opinion. It'll be massaged as much as they can. So it's important to understand that as an investor, so that you understand that we could see lower interest rates. We will see lower interest rates in the U.S. Over the next year. And so you want to try to take that into account, in your investing. And this video isn't going to tell anybody exactly what to do, but I think generally speaking, I've said this, my stance for the past couple years, really, this is before the new administration even came in, was that pretty much since 2022, that we had this kind of fragile stagflation situation where first we had a boom bust from the pandemic stimulus and then the stimulus being pulled back. And that's kind of turned into slow economic growth combined with relatively like inflation that's not coming down, right? So if you think of inflation as transitory, which is what they're trying to pitch tariffs as now, which is ridiculous, because if the cost of goods goes up 20% or something, and then doesn't go up very much after that, that doesn't mean there wasn't any inflation. It just means that the inflation didn't go on we didn't have 20% inflation. If you spread that out over 10 years, you have like 2% extra inflation a year for a decade. That's inflation, right? So you have to understand that if you're holding cash, you need to really think about the fact that it could be the value of that could be eroded over the next couple years. Even if it doesn't end up in the books, you'll notice it when you go to buy things, and when you, especially probably more expensive goods, cars, appliances, things that have to do, with kind of bigger goods where the components are imported and tariffs have to be paid on those and so forth. So food, steaks are, $15-$20 a pound now, probably record high, I would imagine. But nobody pays too much attention to that, not as much as when eggs shot up. But I think most people will see it when they go out and actually buy goods and services. Services are expensive. If you try to get a hotel room in any place that's not like, completely dead of other people, you're going to pay a pretty much higher rate than you paid a few years ago. Definitely pre-pandemic. So the stagflation, I think, is there, or the inflation, I think, is there. And then when we get the jobs report here, you see that the stag part is going to come too. So when we look, the big thing is these revisions. It's highlighted in this CNBC article. So that makes you think, well, the 73,000 jobs they said were created this time around probably will get revised down too. But basically, you haven't had any real job creation. And there's a lot of federal workers that aren't counted in this that have been severed that probably after September maybe will start being included. So the job outlook doesn't look good. New hires of college graduates coming out of college is very low. I don't have the exact numbers in front of me, but that's just a known, that's what's going on now. They say AI is taking the jobs of those new workers. I don't know if that's true or not. I think companies are just like wait and see mode on a lot of this stuff. The broader outlook for everything changes every single day, and you can't plan for the future if you have most businesses when you don't know anything about what the economic future is going to be. So, and we don't really right now. So that's kind of the setup for everything. And I think that kind of the takeaways that you're going to see is a weaker US dollar, for one. So balance is really what I've been aiming for lately at the portfolio level. I added a little bit of precious metals lately into the cash, just took some of the cash and moved a little bit over. If you want more details on this stuff, you can join one of my full services. I'll put the links in the description. Over on Patreon is a good one just to go check out. And then you can just direct message me. I answer messages all day from people. And if I get enough questions on the topic, then I'll just put more broad video out or something. But weaker US dollar. So one of the things I've been doing, diversifying internationally. I like international growth businesses. One that I've talked about, just to give an example, so I'm not just talking too broadly, like Mercado Libre, I think benefits from a lot of this stuff. Really, growth businesses outside of the US, especially if they aren't selling into the US. I bought some companies recently that are more deep cyclicals that do sell in the US, but if you can get products from China and sell them into your country, or services and things that take place outside of the US in a different country that's growing, which is hard to find, admittedly, um, that's a good way, I think, to diversify out of the dollar, the US dollar, which is almost certainly, I think, going to get weaker. At the same time, and then stocks are a good way to do that as well. The big tech stocks, they have growth still. Not all of them, but I own Meta. We recently bought Alphabet here on the channel back in April, and those type of stocks should do okay. But the real future returns are going to come from smaller companies that grow into the next big companies, right? That's kind of the cream of the crop that you want to find. I also like niche companies, even if they're in the US. Niche services are pretty good. What else? So those are just some ideas to put out there. But generally, a portfolio that's balanced with some cash-like stuff. I like floating rate treasuries, short term in the US. TFLO is the ETF that I put my cash in. Now, over time, I expect in the next couple years, I don't really expect any real return, and maybe even a real loss if we have inflation that isn't reflected in short-term interest rates. And just because the Fed lowers short-term interest rates doesn't mean long-term interest rates are going to come down too much, but they could come down enough to maybe get a little bit more action in real estate. Like, it's going to be choppy. I don't think you can really get too far to the side of the boat, right? I think balance is kind of the thing. You want to keep an eye out for where the market goes overboard, and then kind of nibble on your investments when that happens, I think. And that's been working out pretty well for me. I've had some really good winners in the past 6 months, way more than I would have expected. Like the magnitude of the returns over the past year has been more than I would have expected. But those are the type of niche areas that you want to try to find. And that's what I spend most of my time trying to find. So growth, niche, international, along with some cash, because I call it fragile stagflation, because these jobs numbers could really fall. Like, things could, if something goes wrong, turn into recession. It's hard to say that it will, because, when everything's being run by like executive order, the administration can kind of, I feel like they're playing whack-a-mole, right? Like, oh, there's a problem that popped up. Boom. They just do whatever they need to do to try to, and so far they've done like a decent job of that. When you look at all the tariff delays and negotiations and just everything. But that can break sometimes, and you don't know when it's going to happen. So the cash is there to invest in the things that really get beaten down. We are seeing a lot of volatility in this market. When stocks get hurt, they get hurt badly sometimes, and those are the ones that I think can potentially be an opportunity. Maybe outside of healthcare, which is more dangerous. But it seems like every couple weeks or whatever, there's a stock like that I've been picking up that's gotten beaten down. So those opportunities are out there. You need to have cash to take advantage of it. And trimming some of the mega caps is probably not a bad idea here, even though they've been doing awesome. Now, I haven't sold any Meta or Alphabet, but there are some other ones that I think if you needed money, like, you could go to, or that could be cyclical, like an Amazon or something like that. So that's one way. But I'm about a third international stocks, a third cash and treasuries, and then a third US stocks. And it's really a mix of buying whatever gets really cheap. And that's worked pretty well for us. Definitely in April, if you look at the stocks that we bought, even on the public channel here on YouTube, they've done really well. But it's going to be tricky, I think, going forward. So I just think and we have all these meme stocks. We have a lot of garbage stocks that are doing well. Like, just, I'm not going to mention any by name, but if there's a lot of speculation and just kind of scams and stuff, in my opinion, like legal scams now that they, crypto and all that stuff. So that have been doing really well, and that lets you know that there's a lot of money floating around the market. That's, I wouldn't call it dumb money, but it's like gambling. Like, there's a lot of gambling going on in the market, and you want to avoid those because the bottom can fall out of that too really quickly, because you don't know how much leverage all these there. I don't know where people are getting all the money to invest in some of the garbage stuff that they have, but I mean, there's a lot of money floating around. So maybe it's not all borrowed, but usually when things start to blow up, they blow up pretty bad, and you want to be as far away from that type of stuff as you can, and just focus on quality businesses at good prices, and then make sure you have some cash and wait for the market to make its mistakes. It doesn't mean your portfolio won't go down, but if you understand what the possibility is, you understand this market could drop 30% in a month, then you're prepared for it, and you have some idea how far some of these stocks could drop, and you know the quality ones that you would like to buy if they do. That's kind of where you want to be right now. And you understand interest rates are probably going to go lower. That could help some businesses maybe, but it's probably going to help the lower quality businesses more, which makes it kind of dangerous to invest, because the businesses that are going to really benefit from lower interest rates are also probably going to be more susceptible to getting hurt really bad if there's a recession. So I say keep the quality standards up. Don't lower your quality too much because interest rates are low. That might not be enough. Traditionally, it hasn't been enough to save businesses too quickly when things turn down. I think what's going to break this economy eventually is that the middle class is going to run out of money. They already are. Like, it's just ratcheting up, and people can still borrow now. I think they are, but eventually people won't be able to pay their bills, maybe even if they have a job. And I think that's what people aren't, like, people are looking at the jobs, but if the jobs don't pay enough money to pay the bills, and people owe a lot of money, and people coming out of college can't get jobs, and people have to pay back their student loans, and I could go on and on. Basically, the policy so far of the administration is to lower job prospects for college graduates, because you want them to get a job in the coal mines and meatpacking plants, right? If you look at what's actually happening. And I have a hard time seeing how that goes smoothly. And now what can happen, right? I mean, if people get desperate enough for a job, they'll go work at a job that's more dangerous and harder to do, for decent pay. But I'm unsure how that's really going to affect the economy and what that transition is going to look like. And I'm always kind of pretty skeptical about everything. I think I'm probably more skeptical about that, with the immigrants that are being deported, which is a lot of immigrant labor. In theory, it could raise wages, but the problem is I don't think workers have much negotiating power, and if spending goes down, then businesses aren't going to have the profits to want to pay the higher wages. And so there's really going to be kind of this battle. And I think in that process, probably the economy suffers. But we'll have to wait and see kind of how that plays out. But I would, like I said, have some cash, diversify away from the US dollar, be prepared to invest when quality companies hit your buy prices. So that's my end of the month, beginning of the month, I guess, end of the week. I'm just going to kind of get all that out there. And then I'll get back to my individual stock analysis, and we'll have kind of a framework of how I'm thinking about things out there, into the universe here on YouTube. So maybe it makes a little bit more sense when I'm answering people's comments and stuff. Okay, if you found this useful, hit the like and subscribe button. If you have a stock request, let me know. It's been earnings season, so I haven't been keeping up quite as much as I usually do on this list on my chalkboard behind me. But once earnings are over, then I don't get like 12 news headlines in one day that are worth talking about, and I'll get back to the individual stock analysis. And I'll see everybody later.